Thank you, Natalie. I'm honored to introduce our speaker, Ryan Szczepanik. Ryan is a senior wealth strategist at BNY Mellon. He advises families, executives, and business owners on sophisticated wealth and estate planning strategies. Ryan is a former trust and estate attorney. He practiced at the Bay Area firm Hartog, Bay and Hand, and at King and Spalding in their Atlanta and Bay Area offices. He is a California certified specialist in estate planning, trust, and probate law, and is also a member of the Executive Committee of Trusts and Estate section of the California Lawyers Association. Ryan is an expert on charitable trusts and how trusts can play into sophisticated planning, and he speaks regularly on topics for audiences across the country. We are so pleased to have him with us here today, so please give a warm welcome to Ryan Szczepanik.
Thank you, Cindy. Thank you, Natalie, and thank all of you for having me today. I'm very excited to talk with you about unlocking the power of trust in financial and estate planning. What I'm first going to do is share my screen. I have a deck of slides that I'm going to use in today's talk. So let me go ahead and do that now. Okay. All right. Okay, so what I'm going to do today, I'm really excited about this topic because, we're seeing um, increasingly more and more folks out there interested in using and, in fact, implementing the use of trust to accomplish their charitable goals. What I want to do today is I want to start off kind of with the backdrop that we find ourselves in as a society. In kind of the charitable giving and wealth transfer front. And then I want to move into the charitable vehicles that are available to us, and then really hone in thereafter on the two main type of charitable trusts, which are the charitable remainder trust and the charitable lead trust. And we should have some time after I'm done for some questions that you have, which I more than encourage you to submit questions so we can see what's on your mind and address any of those questions with answers. So let's get started. So where are we right now, kind of in the charitable and wealth transfer landscape? I don't think I think I'm stating the obvious when I say we're looking at a very, very large wealth transfer, right? The baby boomers right now, as you can see from this chart from a couple years ago, we're looking at upwards of $100 trillion probably today, or probably by the time we consummate the wealth transfer, going from the baby boomers to the next generation, which is Generation X, and even the generations below that, beginning with the millennials. So we're looking at a massive, massive, and massive amount of wealth that's going to be moving over the next few years and decades, going from that baby boomer generation over to the next generations. I'm Generation X. It's true in my circumstance too, and I'm sure it's true in your circumstance. And what this does is it really provides a very unique opportunity and a wonderful opportunity for charitable giving. We're seeing more and more folks who are in the baby boomer generation who are acclimated to and interested in doing charitable giving. So really the fundamental question is, how do we reach out to those folks? How do we help those folks accomplish their charitable goals? As an advisor, I'm an advisor. I assume many of you are advisors. Really, our job in the charitable space is to help donors accomplish their goals, and I see it as really a three-factor job. One is to help them identify the most appropriate charitable vehicle. Could be more than one charitable vehicle. And that's really what we're going to be focusing on today in this presentation. Secondly, identifying the most appropriate assets to give to charity. Typically, when we're talking about non-cash assets, I think as many of you know, we're looking at low basis stock or low basis assets because that accomplishes generally two goals, right? One is to get a fair market value deduction, charitable income tax deduction when you give during life. And you also give away the gain, right? To the extent there's capital gain, a significant capital gain, when you give appreciated stock, for example, you can give away that capital gain and you don't have to pay tax on that capital gain. So you get both of those benefits. And then lastly, many clients, many donors don't really know where to start when it comes to looking at charitable organizations. So I think our job is really to help them identify the organizations out there that are appropriate to them. As I'm going to discuss with you, one great option is the donor advised fund, because with a donor advised fund, you can accomplish obtaining that charitable income tax deduction by giving to that donor advised fund, which we, commonly refer to with the acronym DAF. And the donor doesn't necessarily have to determine who the end charity is, right? Because the assets can remain in that DAF, and then the donor can make a recommendation on the contribution of those assets that are sitting in the DAF to the end charity. Seattle Foundation certainly has one of the top donor advised fund programs in the state of Washington. So that's certainly an option. And then taking these three factors, right? Picking the correct charitable vehicle, identifying the correct assets, and identifying the end charitable organizations. And then we really coalesce that around the charitable plan, and we then implement the charitable plan for the donor. What I want to first do here as part of this backdrop on where we are is kind of go through a few slides that really show the different perspectives of each of the three generations, oldest to the millennials, and really kind of give you, as you probably already know, an understanding of just the different perspectives that the folks in these different generations have coming into charitable giving. And the reason I want to do this is I just really want to underscore how it's our job as advisors to really meet folks where they are. And each of the folks in these three different categories of generations, they do have different perspectives. And as I'm going to say, we actually at BNY conducted a study recently to really hone in on the different perspectives on charitable giving that each of these generations have. So let's start with the baby boomers, right? 1946 to 1964. This is my parents' generation. My father was born in 1947 and my mother was born in 1950. And you can see here we have what Martin Luther King and the Beatles and a lot of different things here. The 1950s, of course, with the concern about nuclear war. And that's really the generation in which they grew up in, and that's the perspective they have on wealth transfer and charitable giving. We have then the Generation X, and this is my generation. I was born in 1976, so I fall right in the middle of this generation. Here we have the birth of the the personal computer. We have MTV. You see that down there. George Bush Sr., Sesame Street, Nancy Reagan, Richard Nixon, Oliver North. And something I remember vividly, which was when the Challenger blew up in the top right there. We also have the scandals like Enron. And that really kind of has influenced the way we have grown up and the way we have viewed the world of wealth and the world of philanthropy. And then lastly, we have the millennials. And as we know, more and more of the wealth pie in society is being is with the millennials, right? And they have a very unique and different perspective. Certainly, they're the generation of 9/11, as you can see there on the top left. The wars in Iraq and Afghanistan in the 2000s, certainly the financial crisis with the fall of the Lehman Brothers in 2008, and the foreclosures with the homes, and the birth of the iPhone, right? I mean, that I often think to myself, how did we function? How did I function when I was in college? I didn't have a smartphone, right? What did we do? But this is really that perspective, and certainly we have a lot of the tech companies like Facebook and YouTube and the like. Um, and that really educates folks, and again shapes their perspective when it comes to charitable giving. And as I said, BNY together with Camden Wealth, we conducted and then authored a report on the different generations' perspectives on charitable giving. And the insights were very, very interesting. The younger generations, Generation X, millennials, they're much more comfortable being approached directly by charitable organizations, right? Whereas the baby boomers, their attitude was, charitable organizations directly approaching them would be more likely to be viewed as offensive, right? The younger generations, their motivation to charitable giving often is more individualistic, right? It's a sense of duty. It's they're making up their own minds on what causes they want to support, whereas the baby boomers, the study found, were much more motivated by the family tradition, right? What did the generations above, before them, who did they give to? And they wanted to carry forward that tradition, and they viewed it as more of a family legacy than, the more individualistic perspective, which is what the Generation X and the millennials have. The third bullet point here is very interesting. It gets back into the issue of donor advised funds, which I touched on briefly, and I'll describe in more detail in a little bit. The younger generations, they really like donor advised funds, and they really like to rely on different channels of distribution, not relying on just one. Whereas the older generations, they like to give to family foundations and private foundations, and really that's the way the old guard gave. It was less donor advised funds. It was less direct charitable giving. The high net worth and the ultra high net worth generally created private foundations. But increasingly, the baby boomers are liking the idea of the donor advised fund. The more they learn about it, the more they like it, and we're seeing more and more folks at BNY opening donor advised funds and giving to donor advised funds. As I'll describe in a little bit, they're very flexible and versatile, and folks really like them. And then lastly, and this is really the subject matter that I'm going to dive into greater detail on, are the charitable trusts. And by charitable trusts, what I'm talking about generally are the charitable remainder trust and the charitable lead trust, especially the charitable remainder trusts. They're becoming increasingly popular with all the generations. We're seeing more and more charitable remainder trusts being opened and funded for various benefits, which we'll describe in a little bit. Okay, so let's talk about the different types of charitable vehicles. There are many, but the main four would be the donor advised fund, the private foundation, the charitable remainder trust, and the charitable lead trust. And there are others out there, right? We have folks who have established charitable LLCs like the Zuckerbergs, right? Mark Zuckerberg over at Meta, and some others. Some folks uh, have created their own 501(c)(4) special purpose trusts. That's another vehicle that's gaining more and more popularity. But I would say these four are the main four that folks look at and advisors look at. And I think that last point there, what we shouldn't lose sight of is that charitable vehicles can be very, very useful, especially on a tax front, both during life and at passing, right? During life, of course, a donor can obtain a charitable income tax deduction But we're seeing more and more folks utilize one or more of these charitable vehicles in their estate plans at their passing. The creation of a testamentary charitable trust, for instance, or giving at their passing to a donor advised fund in order to eliminate estate tax if they have estate tax exposure, right? So it's important that these vehicles can be used both during life or at their passing. So let's start with the donor advised fund. As I said, these are very much in fashion and just becoming more and more popular. And why are they becoming popular? It's precisely because they're versatile, they're flexible. So how does a donor advised fund work? This slide really kind of dives into it in great detail. So the way a donor advised fund works is a donor advised fund is a fund that is established by an organization. It is a 501(c)(3). What happens is a donor gives assets, contributes assets to the donor advised fund, and the assets can sit in that fund and the donor, once they give the assets to that donor advised fund, they can make recommendations on how those assets are invested while they're within the fund and how, to whom, to what 501(c)(3) charities the assets that are sitting in that fund ultimately go to, right? When the donor makes a contribution to this donor advised fund, think of it as kind of a intermediary. When the donor makes a contribution to the donor advised fund, they receive a charitable income tax deduction for giving those assets to the fund. So the big benefit here is the donor doesn't necessarily have to decide the ultimate 501(c)(3) charities that those assets are going to go to. Instead, they could give it to the fund. The fund will invest the assets. They will get the charitable income tax deduction, and then the donor in the future can recommend to the donor advised fund where the donor advised fund contributes those assets to the end charity. Seattle Foundation has a wonderful donor advised fund, as I said previously. Um, some of the other benefits of a donor advised fund is, well, let's just go back to the income tax deduction issue. So oftentimes when a donor anticipates having a significant amount of income in a year, but they don't yet know to whom they want to give the assets, what end charity they want to give the assets, they could just give the assets to the donor advised fund, right? And they get the charitable income tax deduction and they could decrease their taxes for that year. A lot of donors like the donor advised fund because, in contrast to private foundations, um, the donor can keep the contributions private. And it's very simple to do. It's very simple to open up a donor advised fund. You just have to fill out some paperwork. It could basically happen in a few days. A private foundation typically has a lot more um, burdensome requirements, and there's a lot more transparency requirements. So basically, um, somebody who's running a private foundation has to submit to the government and disclose the donors and the amounts and to whom the foundation is ultimately making contributions. Whereas with a donor advised fund, that can all stay private, and folks really like that privacy aspect of the donor advised fund. So that, in a nutshell, is what the donor advised fund is. And I'm going to get a little more into comparing and contrasting the donor advised fund with the private foundation. What I first want to get into, because I think it's important when we're thinking about the donor advised fund and thinking about just giving to charity in general, are these very significant tax law changes that we are seeing and we continue to see in the state of Washington. Historically, as I think we know, Washington state was a state free of income tax and free of capital gain tax. And that has changed, right? A few years ago, we saw the legislature pass a law that enacted a 7% excise tax on capital gain exceeding $250,000. There are carve-outs for real estate and retirement assets. Um, but we have that 7% excise tax. It's adjusted for inflation. So in 2025, it's a 7% tax on capital gain exceeding 278,000. That law was challenged, right? It went all the way up to the Supreme Court in the state of Washington, and it was upheld. So we have this 7% tax. And then more recently, we have the legislature increasing that amount of tax by 2.9% on capital gain exceeding 1 million, right? So we have 7% tax on capital gain in 2025, between 200, exceeding 278,000 up to a million, and then an additional 2.9% for a total of 9.9% tax on capital gain in excess of 1 million. So we have a very significant income tax in the state of Washington now. What we also are potentially looking at is last week, the legislature in Washington introduced another income tax. This is a 9.9% income tax. This isn't capital gain, this is income tax. Ordinary income tax on income exceeding 1 million in a year. And a lot of folks are talking about this income tax. I think the way it is currently written, Governor Ferguson is opposing it. But what I'm hearing in a lot of the media reports is there's a lot of traction behind this 9.9% proposed income tax on income exceeding 1 million in a year. There's a lot of discussion out there. There's a lot of commentary on affordability in our nation right now. I wouldn't be surprised if this becomes law. So we have a 7% excise tax on capital gain, 9.9 on capital gain exceeding a million, and then another potential 9.9% ordinary income tax on income exceeding $1 million. We also saw a couple years ago an increase in the top estate tax rate in the state of Washington. I think, as you all know, Washington is one of the few states in the country that has its own estate tax. And historically, the top rate of the Washington state estate tax was 20%, and that just increased to 35%. We also had an increase in the estate tax exemption, which is a good thing, from 2.193 million to 3 million. So we have an increase in that exemption. But that top estate tax rate is pretty significant, right? 35%. So all of this change to the tax environment in Washington gives an increased reason to think about making charitable gifts, right? Because with charitable contributions, we can get during life a charitable income tax deduction, and at passing, we can also get a charitable deduction from the estate tax. So all the more reason why we should be helping our clients think through addressing these tax issues by contributing to charity. And plus, we do good, right? We also get funds in the hands of great organizations like Seattle Foundation that do good things with this money for people in need. One, interesting quirk in the state of Washington that I think a lot of people forget or may not even know is that in order to obtain that charitable income tax deduction from the Washington state estate tax, right? The tax on capital gain of 7% on capital gain exceeding 278,000 and 9.9% on capital gain exceeding 1 million. The contributions have to go to a charitable organization, including a donor advised fund, that is principally directed or managed in the state of Washington, right? So if a charitable contribution is given to a donor advised fund that does not have an office in the state of Washington, then that contribution is unlikely to qualify for a deduction from the Washington state excise tax, right? And we need to be really mindful of that because a lot of people are motivated, at least in part, to give to charitable organizations, including DAFs, by the potential to get a charitable income tax deduction. So, in order to do that, they need to give to charitable organizations that have an office in the state of Washington and principally directed or managed within the state of Washington. I think people generally think, what does that mean? That means having an office in the state of Washington and having the officers, most of the officers located in the state of Washington. Seattle Foundation is a perfect example, right? A wonderful organization that is principally directed or managed in Washington, and they have a donor advised fund within the state of Washington. One last thing I wanted to mention about donor advised funds, because this comes up a lot when donors are filling out the paperwork and establishing their donor advised fund. Um, the the way as I described it, the donor advised fund works is once the donor gives to the donor advised fund, right, the intermediary, that donor retains advisory rights. And those advisory rights are to recommend to the donor advised fund where the assets ultimately go, right? What 501(c)(3) charities the assets ultimately go, and also recommendations on how to invest those assets while they're in the donor advised fund. What the donor should always do, and what we should help them think through is who to designate as the successor advisor on their paperwork once they are unable to advise or after they pass, right? Because that donor advised fund likely will still be in existence. So oftentimes what we see is donors designate their spouse or designate a child as their successor advisor. And another good idea is to designate what and charitable organizations they want the assets that are sitting in the donor advised fund to go to if there's no longer an advisor to make recommendations, right? They had themselves, for example, as the advisor. They've then designated their children. And after they all pass, let's say their assets still in the donor advised funds, well, where are those assets going to go from the donor advised fund? If they don't designate any end charities in their paperwork, then the organization that's running the donor advised fund will have the discretion to determine to what 501(c)(3) charities the assets that remain in the donor advised fund go to. One other important thing about the donor advised fund is there's really no time limit for how long the assets can sit in the donor advised fund. They could seemingly sit in there in perpetuity. And that's another benefit versus the private foundation, which is a good segue into this slide, which shows the differences between the donor advised fund and the private foundation. I would say the theme here is that the donor advised fund, think flexibility, think versatility, think privacy. Private foundation, a lot more burdens and requirements, right? With a private foundation, there's a minimum annual payout requirement of 5% of the fair market value of that private foundation's assets. The charitable deductions, there are more restrictions generally for donor advised funds. For cash contributions to the donor advised fund, you could deduct 60% up to 60% of your AGI, adjusted gross income, and up to 30% for non-cash. Private foundation is 30% for cash and 20% for non-cash. There's an excise tax that applies to private foundations, does not apply to the donor advised fund assets. For the private foundation, it's generally 1.4% of the investment income. And then there are just all these requirements for filings with the government, filing 990 forms, transparency. You have to disclose generally the donors, where the assets are going to. And there's just a lot of costs for running a private foundation. That's not to say private foundations aren't well suited for certain circumstances, right? I would generally say that folks that are very interested in legacies and having their name out there in society. Think about the Clinton Foundation, the Gates Foundation, foundations like that. A private foundation is certainly something people should think about. Also for foreign giving, I would say generally private foundations might be a little easier if the goal is to give to charitable organizations that are located abroad. But those are really the distinctions. Generally, people, once we walk through this slide and talk about the pros and cons of the donor advised fund versus the private foundation, they end up saying, I want to do the donor advised fund because they really like that flexibility and they really like the privacy part of it, and it's a lot less costly, and it's just easy to set up and administer. Okay, so we're now going to move into charitable trust. So we're going to start with the charitable remainder trust, and then we're going to move on to the charitable lead trust. So beginning with the charitable remainder trust. Well, what is this? What is the charitable remainder trust? So the charitable remainder trust, it's an irrevocable trust, right? In contrast to a revocable trust that someone generally creates for their own personal assets to avoid court for incapacity planning. The charitable remainder trust is an irrevocable trust. So when a person gives assets into this trust, generally it's going to be very, very difficult to change the terms of that trust once they give assets to that trust, once they execute that trust. So the way the charitable remainder trust works is an individual will hire a lawyer. That lawyer will draft this trust. And there are requirements under the Internal Revenue Code for what qualifies for a charitable remainder trust. And generally, those requirements are that um, the assets that are transferred into this trust, at least 10% of that funding of the trust, 10% of the fair market value of those assets, have to go to a charitable organization at the end of the term of the trust. The term of the trust generally can be either 20 years or the lifetime of the beneficiaries designate the non-charitable beneficiaries that are designated. Um, so what happens is during the term of the trust, right, either 20 years or a lifetime, the trust will be funded, and each year an amount of the assets will go out to a beneficiary, a non-charitable beneficiary, and this will happen throughout the term of the trust. And then on the conclusion of the trust, when that term ends, whatever's left in that trust will go to one or more charitable organizations. So the beneficiary during the term of the trust is a non-charitable beneficiary. Typically, it's the grantor, the person who created the trust, or the grantor's spouse. It could be somebody else. Now, if it is somebody else, at the time of funding the trust, there will be a gift, and the grantor will be required to file a Form 709 with the IRS when they fund this trust. So again, funding the trust, at least 10% at the end of the term of the trust has to go to charity. There's an annual payout each year to a non-charitable beneficiary. And at the end of the term of the trust, whatever's left in this trust goes to a charitable organization. It could be donor advised fund, could be a private foundation, or it could be directly to one or more charities. And that, in a nutshell, that's how it works. I'm going to go through kind of the advantages and the disadvantages. But first, I want to talk about why these are becoming so popular today. And this is going to be, a nice segue into the conversation of what are the benefits. Um, First of all, they're becoming very popular because the stock market, of course, is at historic highs, right? We're near 7,000 on the S&P, 50,000 on the Dow. So a lot of folks have had a massive run up in their personal holdings and have a lot of large capital gain, right? Now, the beauty of the charitable remainder trust is when the assets are contributed to the trust, the donor, the grantor, the person who created the trust, they get a charitable income tax deduction in the amount of what goes to the charity at the end of the term of the trust. And generally that's 10%. It has to be at least 10%. Generally, I see people creating charitable remainder trusts to have a 10% remainder going to the charity. So if it's 5 million, the charitable income tax deduction is 500,000, right? 10%. And that charitable income tax deduction is taken by the grantor when they set up the trust. And they can fund the trust with, for example, stock that has appreciated quite a bit. And the stock will be going into the charitable remainder trust. And the charitable remainder trust is a tax exempt trust. So when the stock is sold within the charitable remainder trust, there is no income tax paid at that time. Now, each year when there's a payout to the non-charitable beneficiary, right, the grantor or the grantor spouse, there will be an income tax applied to that portion of the amount that goes out each year to the grantor or the spouse or the other non-charitable beneficiary. But the benefit is the entire amount that went into the trust when it's sold, let's say it's 5 million with zero basis stock, that's a significant capital gain, and we're looking at a deferral of that capital gain to allow those assets from the charitable remainder trust grow, right? So the fact that the stock market has run up so much and folks have this massive capital gain in their stock holdings, it's really giving them the impetus to fund these charitable remainder trusts and defer the capital gain. We also see that the S&P 500 is historically over-concentrated in the Mag 7 and other big tech. That presents a concentration risk, so folks want to give some of their over-concentration into a charitable vehicle like a CRT. There are a lot more private companies now than public companies. I was reading somewhere that we have only maybe 4,000 or so public companies, and many years ago there was something like double that. So a lot of companies prefer to stay private. A lot of public companies are going back to being private. We have a lot of unicorn private companies, which are $1 billion value private companies. So we have a lot of founders who have, and a lot of early stage employees who have these low basis appreciated stock, and they want to diversify their holdings, right? Giving it to a charitable remainder trust is a great option. We're seeing a lot more private alternative investments in folks' portfolios. That means they have a lot more less liquid assets. So one of the beauties of the charitable remainder trust is you can think of it as an annuity. Each year, the non-charitable beneficiary, right, the grantor or the grantor spouse, they receive that annual payment, and that payment can be used to cover their lifestyle expenses while their other assets outside the CRT, right? They're less liquid alternative investments. They can stay invested and they don't have to worry about those assets for generating the liquidity to cover their lifestyle needs. And then lastly, here I put the younger generation is just much more reluctant to leave a lot of wealth to their children, grandchildren, and subsequent gens. I work with a lot of founders. I work with a lot of folks in the tech industry, and I see more and more folks who are, less likely to max out their GST exemption. They want to give their children something and their grandchildren something, but not a lot. So more and more of them like this idea of contributing to a charitable remainder trust whereby they can receive an annuity and a certain amount goes to charity and they receive an income tax deduction when they give to the charitable remainder trust. I'm going to go through a few case studies now. As I was just saying, I represent a lot of, I work with a lot of founders of tech companies, and they're a cohort who definitely like the charitable remainder trust. A lot of them founded a company, founded a startup, right, that's now successful. Seattle's a place where we have a lot of founders. The Bay Area is another place that I work with. And a lot of them have the zero-based founder stock that's appreciated quite a bit because their startups have been very successful. The problem is their asset base is highly concentrated right now, right? Their wealth is highly concentrated in their startup, and they want to diversify their holding. So what a lot of them like to do is they like to create the charitable remainder trust, and they give a certain amount of their founder stock into that charitable remainder trust. It's a tax exempt trust, so when they put the assets in there, they could sell those. They could sell the founder stock with zero basis. They don't incur the capital gain right away. It's deferred, right? It's only paid via each installment payout that they receive. They can use that charitable remainder trust as an annuity stream to cover their lifestyle expense. They contribute to charity rate, so at least 10% has to go to charity at the end of the term of the trust. They get a tax deduction when they give to the trust. So it really checks off a lot of boxes as you can see here. And I'm going to go through this one example. This is actually a live example I have with a client that I've been working with, and we're having a big meeting this Friday. This individual founded a company that likely will be doing an IPO fairly soon. And what he wants to do is he wants to put $5 million into the charitable remainder trust. He has zero basis founder stock. So when he puts the 5 million in, he's going to get a charitable deduction of 500,000, right? 10% of the initial funding. The after-tax value of that is about 250,000, right? Because he is subject to approximately 50% tax rate. I think the beauty here, as you can see in the two right columns, we have one column that shows what happens when you fund a CRT with 5 million. And the column next to that is what if this person does not use a CRT and just sells that $5 million stock. And I think the pretty surprising thing here is the ending value in the investment management account in 2045 using a charitable remainder trust in which 10% has to go to charity versus not using a charitable remainder trust and just selling that $5 million in stock and incurring the capital gain. The amount the person has who's created the charitable remainder trust, the amount they have in their IMA that has received the annual payouts from the CRT is actually more than the person who doesn't use a CRT, right? Doesn't contribute 10% to charity. So using a CRT with 5 million of zero-based stock results in more money in the hands of the grantor, right, than the person who does not create the CRT and just sells that 5 million in zero basis stock. So that's a pretty surprising result, and really kind of showcases how valuable this CRT is. After another 18 years in 2063, still the CRT produces more in the IMA account of the person who created the trust than a person who does not create the CRT. Plus, the person who created the CRT at the end of the 20-year term of that CRT gives about 2.25 million to charity, which is another big benefit, right? And they get the charitable income tax deduction. So here's a summary slide of what we just talked about. Creating that 20-year charitable remainder trust, you give to charity. The person who creates it has more in their IMA account after 20 years and more in their IMA account after 38 years in 2063 than the person who does not create the charitable remainder trust and then just sells that $5 million stock and invests it. One last thing, the bottom line of this summary slide shows that the person who creates the CRT, they receive that annual payout that could cover their lifestyle expenses, right? And the annual payout ranges anywhere from 163,000 to 350,000 approximately, and that can be used again to fund the lifestyle expenses of the grantor, the person who created the CRT, so they don't have to tap into their other investments and incur the capital gain to generate liquidity from those other investments. Again, really valuable, this CRT. One other case study we have with the CRT. I work with a business owner. She had a family business. Her husband passed away several years ago, and they had a very successful family business, like a door repair manufacturing shop. And she sold the company to a private equity firm, which we see a lot of in the family business arena. And a CRT is very valuable for business owners who want to sell a business. Why? Because if the founder of the business contributes their stock in the family business to the CRT well in advance of the sale, prior to executing a letter of intent, they avoid the assignment of income doctrine, and they could put that stock into a tax-exempt entity, which is what the CRT is. So when the company is sold, when that stock within the CRT is sold, it's sold within a tax-exempt entity and there's no tax due. Now, each year, of course, the grantor will receive that payment stream. That pro rata share of what they receive each year, that incurs a tax, but the rest of what's in that trust does not incur the tax, and it gets to be deferred through the lifetime of that CRT. This one was wildly successful. She deferred the capital gain on the sale of her company's stock. She received that annual payment stream, which she could use to cover her lifestyle expenses. She received the upfront charitable income tax deduction, 10 million. She received a $1 million charitable income tax deduction, right? 10% remainder goes to charity. And she contributed to charity, right? And she's a charitable-minded person. So it checked off a lot of boxes with her too. Here are things to watch out for with CRTs. I'm not going to go through in detail each of these items. But remember, as I said before, if the non-charitable beneficiary who's receiving that annual income stream is not the grantor or their spouse, there will be a gift. And a 709 will have to be filed in the year in which the charitable remainder trust is funded. You cannot fund a CRT with S corporation stock. It has to be either a C corp or an LLC partnership. You need to be aware of unrelated business income tax, UBIT. This is income from a trade or business regularly carried on that's not substantially related to the charitable purpose. I think people get in trouble with this one when they fund a CRT with leveraged real estate that is not their primary residence and that they're receiving income from, for example, rental income, commercial property, that can incur UBIT, and the government taxes at 100% rate unrelated business income tax. So you need to watch out for that. And the last thing here is the CRT has to have the liquidity to pay the annual payments. If the idea is to fund the CRT with an asset like a family business company and the sale is not going to take place for a while, you can structure the CRT as either a flip CRUT, which means no annual payments have to be paid out to the non-charitable beneficiary until the event occurs, like the sale of the company, or a NIMCRUT. This is a net income with makeup charitable remainder unit trust. That's a mouthful. The way that works is each year the annual payment to the non-charitable beneficiary is the lesser of the income or a certain unit trust percentage. So if there's no income, nothing has to be paid out in those years. It's made up in the later years when the trust generates the income. I'm going to go through quickly a few other slides here because I know we're running out of time. A charitable lead trust is the inverse of a charitable remainder trust. So with a charitable lead trust, like a charitable remainder trust, it's irrevocable. And so the assets are placed into the charitable lead trust. And each year there's a payment that goes to a charitable organization. And at the end of the term of the trust, whatever's left goes to non-charitable beneficiaries. I typically see these charitable lead trusts used for folks who want to do wealth transfer. And the idea is they zero out this charitable lead trust, meaning they fund it, and 100% of what they fund it with is going to go to the charitable organizations during the life of the charitable lead trust. And the appreciation that happens within this charitable trust that exceeds what we call the 7520 rate. That's the government rate on the interest. Right now it's around 4.5%. All of the appreciation within the trust that exceeds 4.5%, that's appreciation that will go out tax-free at the end of the term of the charitable lead trust to the non-charitable beneficiaries. Oftentimes it's irrevocable trusts for the grantor's children. Oftentimes those trusts are dynasty trusts, GST exempt trusts. But this is a very good strategy for doing wealth transfer for those clients who are interested. Here's an illustration, and I'll have a brief case study. We have a client who owns a family business and has significant estate tax exposure. His revocable trust has a provision that says whatever portion of his estate when he passes is subject to estate tax, that amount of assets will fund a testamentary charitable lead trust. All of it will go into this charitable lead trust, and that full amount will get paid to charity over the lifetime of that charitable lead trust. All of the growth within that charitable lead trust that exceeds the 7520 rate at the end of the term of the lead trust will go out to irrevocable trust for the benefit of his descendants, children, grandchildren. The family business that funds this testamentary charitable lead trust, it will, upon his passing, be sold to an ILET in which he has a life insurance policy. And the ILET funds, the 25 million, will pay that charitable lead trust, which will then be used to make the annual payments during the 10-year charitable lead trust to the charities who are designated in that charitable lead trust. Folks who have estate tax exposure, this is a complex but a very good strategy on how to eliminate that estate tax, how to give to charity, and how also to prepare the heirs to run the business. Because we have, the children and grandchildren could be grieving. So this 10-year period allows the children and the grandchildren to get up to speed and run the family business after the patriarch or the matriarch who has been running the business. It allows them to kind of get up to speed. You can have a trustee of this charitable lead trust. That's a corporate trustee that's assisting the children and the grandchildren until they're up to speed to run the family business. The last slide I have here is a quote that I really like, and it talks about folks who, want to teach their children and subsequent descendants about wealth. And, really the best way, in my opinion, to teach the next gen about wealth is to introduce them to wealth through charitable giving. It gives them a nice lens through which to think about the wealth, look at it through a charitable lens. And what James Hughes says here is that families will often learn more about long-term wealth preservation through the process of learning to give away than the process of learning to accumulate and spend. And that can't ring any truer than today. With that, I'm going to hand it back over to Cindy and Natalie, but I hope you learned a little something about charitable trust and the greater use of and benefit of charitable giving.
Great. Thank you so much, Ryan. And we have some really great questions in the chat, and I want to encourage people to add their questions in the chat. We're going to get through as many as we can. I'm going to start off a question that came through. Do I understand correctly that a gift to Fidelity Charitable or Vanguard DAF would not qualify for the capital gains tax exemption, and how does that calculation work?
It very well may not. There's not a ton of authority on what, and I'm going to go to the slide here, on what constitutes an organization that's principally directed or managed in Washington. But the issue is the donor advised fund being administered by a charitable organization that's principally directed or managed in Washington? And the concern with giving to a Fidelity or a Schwab is whether they would be determined to be principally directed or managed in the state of Washington. And they very well may not be. And if that's the case, then your charitable income tax deduction from the excise tax, right, the 7% on amounts exceeding 278 and 9.9 on amounts exceeding 1 million, that would be disallowed. So it's something I would definitely look at. Again, unfortunately, there's not a whole lot of authority on what that means. And the problem with not having a lot of authority is there's greater risk. So, giving to an organization like a Seattle Foundation that unquestionably is principally directed or managed in Washington may be something you'd want to think about.
Thanks, Ryan. We have a couple of questions about distributions related to the CRT, so I'm going to try and ask them at the same time, even though they're slightly different questions. The first question is, does there have to be a payment stream as part of the CRT? And the second question is, what is the tax treatment of the CRT distribution? Is it all ordinary income?
Those are two fantastic questions. So on the payment stream, if the charitable remainder trust is created in a traditional fashion, yes, we have to have a payment stream each year. But as I said, the charitable remainder trust can be created, as you can see in this last bullet point here, as something called a flip crut or a nimcrut. And in those circumstances, we can formulate the annual payments where we defer for a few years, or we only pay out the income. So there's ways to fashion the CRUD. It can be very flexible, whereby we don't have to make a payment in the early years of the CRT. The second question is the income tax characterization. So the way a CRT works is what we call worst in, first out, WIFO. So the any income that's generated within the CRT that's ordinary income, that will be deemed to come out first. So that's the income that is the highest tax rate. And then once the ordinary income tax comes out, then it's the capital gain, right? That's taxed at a lower rate. Then it would be the principal. So it's worst in, first out. I could go into a lot of detail, more detail on that. So it's a bit of a nuanced answer. It depends on the characterization of the income that's generated within the CRT.
Okay.
Thanks, Ryan.
Thanks, Ryan. Another quick question. How does your CRT example avoid 50% in taxes? And then they said, I see 37.1 as state plus fed.
Yeah. So I really want to emphasize that the tax is not avoided, it's deferred. Okay, so as I said, each year when the payment comes out of the CRT to the non-charitable beneficiary, and again, it could be, some years we could create a NIMCRUD or a flip CRUD. So the early years we don't pay out the income stream. But each year when a payout comes out, say 10% or 8%, that amount will incur an income tax based on the WIFO that I just discussed. But the rest of the income, right? The example of 5 million of zero basis stock, it remains within the tax-exempt trust and that tax is deferred, which allows that money to compound free of tax. And each year, when we receive a payment stream that comes out, that small portion is taxed, but the rest that remains in the trust. So it's a deferral mechanism, not an avoidance. And as far as the tax rates, as you can see down here in the footnotes, the 37.1%, this is a California client. So the 37.1%, that would be the capital gain rate when we combine both federal and state. And the 50% is an ordinary income tax rate. Top rate of 37% plus the top rate of California 13% comes out to 50%.
Think hopefully we have time for one more question.
Yep.
And this is a Washington tax question again. So, is there a limit on the amount of the charitable gift allowed by Washington state as a deduction against capital gains taxes? How is it calculated? I.e., is it 100% of charitable donations deduction from the total amount of taxable capital gains? Mouthful.
Yeah. So the deduction, I believe, the cap on the deduction, is 1 million adjusted for inflation. I believe it's 111,000 is the cap for 2025. And again, we're talking about the deduction allowed against the Washington state excise tax as shown on the slide. The 7% exceeding 278,000, the 9.9% exceeding 1 million. I think that answers the question.
Yeah, thank you.
Yep.
Okay, well, I think that brings us to time today. Thank you all so very much for coming and being such amazing, engaged attendees with great questions. Also, special thank you to Ryan for providing all of this user-friendly information to us. We really appreciate it. Two final reminders. One is when you leave the webinar today, you'll be prompted to take the survey. Please do so because you will be entered to win a prize. And then I think there was one other thing I wanted to mention. Oh, of course, we'll be sending a follow-up email as well with the recording of this event. So please take the survey, watch for the recording, and we hope to see you in the next webinar. Thanks, everyone.